Okay. Good evening, everyone. Starting the class now. Okay. Like I said, we'd continue from where we stopped on patterns. I would be showing us the pattern and I'll be using a PDF just like the last time. So good evening, everyone, and back to class. Sorry for being away for a long time. So I want to believe we stopped at flags. Stopped at flags. We've done wedges. Okay. I'll be starting from flags. I've explained in the last class that I would not be touching the trading patterns and the pattern risk reward because it's just a single concept you need to know about everything and to apply to every other one. So yeah. So this is a flag. I think we've talked about flag, but notwithstanding, I'll be starting from flag. So this is just the pattern of a flag. A flag is like a very short channel. I've spoken about channel here where we have it can either be a rising channel or a falling channel, where you have your support and resistance bounding to your support and resistance together in a particular pattern of trend. It can be in a falling trend or a rising trend. So this now is a bullish pattern. This bullish pattern just it symbolizes a pullback or a retracement. It symbolizes just a pullback or a retracement. It's just like a normal where you have your what's it called now? Where you have your extension and your retracement. So the flag is just a form of retracement. In this case now, this is buyer's exhaustion. So the pattern is just buyer's exhaustion. So now we have an impulsive or extensive move, and then a retracement back to the downside, and then another impulsive move. So that is just the pattern. So let's see a live example. Let's see a live example of the pattern. Let's see a live example of the pattern. Okay. Here now we have an uptrend. Impulsive move retracement, 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 impulsive move retracement. And then you can see this pattern forming. You can see this pattern. Then you can see this pattern falling. This is just a form of retracement compared to how far we've been coming. It's a channel, but the channel is in the reverse direction of the initial trend. Now we have an uptrend in this case, but this channel forms like, just like I said, like a flag. You have your support and your resistance. Here now is your support and here's your resistance. So this is just a pullback from the initial trend move. From the initial trend. So this is just a pullback from the initial trend. After this pullback, we have a breakout here and then a retracement on the resistance, on support rather, sorry, resistance rather. On your resistance, then an impulsive move to the upside. So now we have 1 to 2, which is the major trend, then 2 to 3, which is the pullback, 3 to 4, which is the breakout, and retracement then to the upside. So now if you're trading this and you cite a pattern in an uptrend, you cite a flag pattern in an uptrend, you hold on, you don't just jump into the trade, you hold on, you wait for the breakout and the retracement before picking the trade. So now this is an uptrend, for instance. Sorry. Okay, so now this is an uptrend, for instance. You wait for the retracement. You've seen the flag pattern forming. In the uptrend, you wait for it to break out before jumping into the trade. You don't just go in blindly. No. fine, you know it is trying to form a flag, but you are not sure yet what type of flag is it it's even forming, or if it's a flag at all. It can come back and break down below here, which invalidates the pattern. But you wait for it to break out to the top, to the upside. You wait for the retracement back to at least the last valid lower high before picking the trade. So you don't just jump into the trade because you see it's forming a flag pattern. No, you wait for it to break out, then retrace before going into the trade. So now we're looking at 4 things from 1 to 2, which is your initial trend. In this case now, this is an uptrend. Then you see it forming a flag pattern. This flag pattern is more like a choppy trend. It can be in form of a choppy trend or consolidation or a ranging market, but in a particular direction, which is against the initial trend. Now we have an uptrend, but the flag will come in a direction that would go against the initial trend. This is an uptrend, but you have the flag falling downwards, which shows buyer's exhaustion. It shows buyer's exhaustion. The buyers are tired here. So now the sellers are coming in temporarily, but in a trend. So now you wait for the breakout and the retracement on the breakout level, which is the last valid lower high before picking this trade. So you don't just jump in. If at all you missed any of this move, any of this retracement moves here, and you sight the flag, then be happy. But you have to wait for it to break out to be very sure it's actually forming a flag before going into the trade. So I hope we understand that. We'll be going to our next pattern now. So now the first one was a bullish flag. A bullish flag. A bullish flag has a bullish flag points downward. The name, it comes bullish, fine, it is going down, but we still call it a bullish flag because it symbolizes a bullish move. A downward flag symbolizes a bullish move. That's why we call it a bullish flag. So in this case now, it's a bearish flag, although pointing upwards, but it's a bearish flag, although pointing upwards. A bearish flag, although pointing upwards. So just the same thing, but in the reverse direction. The same thing, but in the reverse direction. We have from 1 to 2, which is the initial trend. We have from 2 to 3. Sorry. Okay. Now we have the initial move, which is from 1 to 2. That is the initial trend. Now we have from 2 to 3, which is the retracement or the pullback. Then we have from 3 to 4, which you wait for it to break out at 4. Then you can pick your entry at 4. Let's say a real market example. You can see this trend now pointing downwards. It's very sharp, pointing downwards. Then at 2, it formed a kind of retracement going up, down, up. And then it broke out at 4. It retraced to level around 4 before going downwards. So when you sight this type of trend, and take note of something, a flag does not form for a very long time. It is not a channel. When it's extensively long, or when it is too long, it becomes a channel. It becomes a channel. So in this case now, let's say you're picking your analysis, or you're drawing your analysis from 4 hours, and you see this under 4 hours. This is a bearish flag under 4 hours. But let's say you go to 15 minutes. This is no longer a flag under 15 minutes. This now becomes a channel under 15 minutes because it will be very long. So, and the way you trade it based on looking at it from 4 hours might not necessarily be the same way you trade it looking at it from 15 minutes. From 15 minutes, I might be interested in picking, let's say I'm doing my analysis from 15 minutes. Obviously, I'm looking at a short time trade. So from my 15 minutes, I'll be looking at picking a buy. Why? Because I'm seeing a rising channel. And I would be foolish picking a sell in a rising channel because I would want to go with the direction of the market because I am trading short term. Take note, you're running your analysis now from 15 minutes. You are seeing a channel, so you don't want to pick buy because of that channel you have seen, because of the move in that channel you have seen, which is a rising move. But if you are looking at it from the concept of 4 hours, where you want to trade long term instead, you'd be looking at a sell, because this is a bearish flag. You'll be looking at a sell. If it were to be from 15 minutes, I just want to pick, let's say I want to trade from here to here in a buy, I would make my profit and I'll be out of the market. But if you are trading 4 hours and you are picking a buy from here to here, you might really not, fine, you'd make profit, but it would break out in no time, and you holding the market long term, you just run into losses. But those trading for 15 minutes, they are looking at short-term trade. They are scalpers, so they are looking at short-term trades. I hope that is understood. So we'll be moving to the next. This is a pennant. And it's very similar to the symmetrical triangle. It's very, very similar to the symmetrical triangle, but this one forms with a very short, what's it called now? It has a very short leg. You can just see it's 1, 2, 3, 4, and that is all. 1, 2, 3, 4. It might be more than 4, it might be lesser than 4, but it is shorter compared to a flag. I hope, let's go back so you see the flag I'm talking about. So you see the symmetrical triangle I meant, not flag, pardon. Okay, now look at the symmetrical triangle. You can see this one is long and big. This is longer and bigger, you can see. But a pennant is just very small. It might not be more than this part. So when it is this big, we're looking at a triangle now. But in that case, the one we are talking about at the moment is a pennant. And take note, for a triangle, it's a continuation pattern. If you can remember, we spoke about continuation and reversal patterns, where some can be both continuation and reversals. But in this case, this is a continuation pattern. So let's look at the pennants now. Please take notes of these things. If you've forgotten what we discussed earlier, I would recommend you go back and watch the videos. Let's see. The pennant is also a continuation pattern, but you can see it's very short compared to the flag. You can compared to the triangle rather. You can see it's very short. So just the same technique. You wait for it to break out. If possible, retrace. You don't just jump into it like that before picking your entry. Let's see a live example. You can see just one from the move, from the initial move, 1, 2, 3, 4. You can see they are both equal sides. It's not pointing downwards, it's not pointing upwards. The legs are of equal length and probably equal directions, kind of. This is pointing up, this is pointing down. They are not both pointing upwards, unlike the bullish triangle or the bearish triangle or something. They are both equal, pointing downward and upwards. So you can see after the breakout, it retraced before you pick your entry. So here now, this is a bearish pennant. Take note of the bullish pennant. It comes from down, hits the first point at 2 before going to 3. But notice the bullish, the bearish pennant rather. It comes from the top, hits 2, goes back to 3, and like that, then breaks out here with a retracement. Let's say live example. From the upside to 2, 3, 4, breaks out here, retraces, and you pick your trade. So these are very simple patterns. That's why I'm not wasting time on them at all. So this is a double top. If you've been following my classes, I would have mentioned you should be conversant with this. This is a double top, just like an M pattern. This is a double top. Let's look at a live example. It's coming now from the double top symbolizes a reversal pattern. Let me mention that. It symbolizes a reversal pattern. So what does this, sorry about that. So what does this double top mean now? It means that the buyers can no longer go further And now there is about to be a change in trend. You can see it was a buying trend. It retraced, but it could not go higher below the former higher high. And then it broke down, it broke here, it broke this level below the last valid higher low, which then, what's it called now? Which then confirms a change in trend. You can see this was an uptrend, a retracement. It went up, but it could not break below this level. Then it retraced and it broke the last valid higher low, and this confirms a change of trend, So a double top now is a reversal pattern to the downside. When you see a double top, we are looking at a retracement and a sell. When you cite a double top, we are looking at a retracement and a sell. Where would it retrace to? It retraces to this level here. Up, down, up, down. So this is the neckline. This point is the neckline. So it retraces back to the neckline, then you pick a sell. I hope we are following. Then a double bottom is just the direct opposite of a double top. A double bottom is the direct opposite of a double top. I think we're getting close to finishing the pattern soon. Okay, now this is a double bottom. A double bottom is also a reversal pattern. A double bottom is also a reversal pattern. Now this is coming from the upside. Hola, Victor, welcome to class. This is coming from the upside. It hits this point, it retraces back up and tries going down, but it could not break the last valid lower low. Then it reverses back upwards and breaks the last valid higher low, which then confirms a change of trend. It then confirms a change of trend. It breaks here high, it traces back to the neckline, this point, and it starts going up. I believe this is understood. So this is a triple top, just the same thing as a double top. So I don't think I'll be wasting time here at all. A triple top is just, it's having three highs. You can see it comes one, goes down, two. This point now might not necessarily get to this level. It's not compulsory rather. It might not get to this level, but if it does all the same, it might not get to this level. It reverses back up, hits this point, and comes back down. Then what are we looking at? We're waiting now for a break down below the neckline. This now is the neckline. We're waiting for it to break this region and a retracement then to the downside. Then the opposite, the direct opposite, is the triple bottom. The triple bottom, just the same thing with the double bottom. It is also, it's a reversal pattern as well, and it changed the trend from downtrend to uptrend. You can see it was coming down from here down to 1, 2, 3. It still could not break this level. It went back to 4. It came back down, still could not break this level. Then upwards. Then after breaking 6, you wait for a retracement and to the upside. So this is the end of patterns, and this is just a summary of what we've done so far. A symmetrical triangle is a continuation pattern. You can have a bullish or a bearish symmetrical triangle. Its occurrence is very high. So its term now, it can be medium or long term. That is, it can hold for a short, a medium time frame or a long time frame. Then the ascending triangle is also a continuation pattern, but for the ascending triangle now, it is a bullish pattern. Then its occurrence is medium, is not that high. It can hold for a medium time frame or a long time frame. The same thing for the descending triangle. Then the head and shoulders is a reversal pattern, and it is a bearish. Its occurrence is low, although I've seen head and shoulder in my charts a few times, and it's actually worked very well. Its term, it can be medium to long term. Then inverse head and shoulder, just the direct opposite of this. Cup and handle, this is very, very low. I think I've seen it once so far. Cup and handle, I've seen cup and handle once since when I've been trading so far. And it's a long term. Inverse cup and handle, the same thing, long term. And its occurrence is very, very low. Then the falling wedge, I've seen the falling wedge a lot of times. And its direction can be neutral. That is, it can be a continuation or a reversal pattern. It can be medium to long term. The rising wedge is just the direct opposite. The rectangle, we talked about that. The rectangle looks just like the rectangle looks just like double bottom or the double top. It's a continuation pattern depending on the type of triangle. It can be rectangle rather. It can be bullish when it's coming from the downside going up. It's a bullish rectangle. When it's coming from the upside going down, it's a bearish rectangle. Its occurrence is medium and it can be long. It can be medium to short to long term rather. Then the flag is a continuation pattern. We just spoke about the flag. It's a continuation pattern. We can have a bullish flag or a bearish flag. Its occurrence is very high. It is very, very high. I see this a lot in the market. Its occurrence is very high, and it can be for short or medium term. Remember, when I was speaking about flag, I told you it does not hold for a very long term. It's just a short term. When it becomes extensively long, then that is a channel. That is a channel. The same thing for the pennant. The same thing that happens under the flag happens under the pennant. Then the double top, which we just spoke about, is a reversal pattern. The double top is a reversal pattern, and it's a bearish pattern. That is, we're expecting it to sell. Its occurrence is very high, like very, very high. Double bottom is a reversal pattern as well, but it is a bullish reversal pattern in this case. Its occurrence is also very, very high. It can hold for short, medium, or long term. Then the triple top is just the same thing with the double top and double bottom, just that in its own case, its occurrence might be very low. So now we've come to the end of patterns, and I recommend this book for anyone. It has copyright. This book was not written by me. I got it from tradingspine.com, and you can get this book from them at any time. Yeah, it's a very good book, I must commend, and very comprehensive, short and comprehensive. So you can go through this book. If you are interested in having the PDF, you can just let me know, message me, and I'll give you the PDF. But everything contained in this PDF is actually nice. So these are just summaries. Of what we've done so far. All contained in this book. So this, we've come to the end of patterns for this very time. There are more complex patterns that I would be bringing up probably in our next class, which should hold on Wednesday. That is next tomorrow. Please do not miss it. So I'll be bringing up patterns like, we have the BAT pattern, the ABCD pattern, the BAT pattern, the ABCD pattern, the ABC pattern. We have the crab pattern. We have the Elliott waves. We've not spoken about the Elliott waves, and we're speaking about Fibonacci very soon. So please, if you are interested in the PDF, let me know in my DM. I'll be dropping it. If you're interested in PDF, let me know. Once again, the PDF is from Trading Spine, the Forex Trading Guide Technical Analysis Series, Forex Chart Pattern in depth, from tradingspine.com. The book is from Trading Spine. If you're interested, you come to my DM and the book will be available. I do not want the video to be extensively long, unnecessarily long. So I'll be stopping the class here, and we will continue from here on Wednesday, not with this book, but now with the patterns I'll be bringing. Like I said, we'll be talking about the crab pattern, the ABCD pattern, the BAT pattern, Elliott waves. I don't think we can talk all about this in one class, so we'll probably break and continue others later. But just take note, we're talking about the crab pattern, the ABCD pattern, the BAT pattern, the Elliott waves, and there are more to it, but I really can't remember at the moment. So see you in the next class on Wednesday. Have a great time. Bye bye.